to another episode of The Finish Line. Today we're joined by Shael Weinreb from the Home Equity Partners to talk about how homeowners are tapping into their equity. So we're going to dive into what this new product and lender does and how it works and who it's actually suitable for. Shael,
Great.
please introduce yourself and a little bit about the Home Equity Partners.
Yeah, thank you so much for having me. So I'm Shael Weinreb. I'm the founder of the Home Equity Partners. Sort of in a previous life, I was a lawyer and then went into real estate development for a number of years and then transitioned to become an entrepreneur.
Nice.
So I did that at the start of 2024. We opened up the company in March of 2025. So we've been around for a little over 13 months now,
Nice.
and it's been great. We're really excited. People have really started to learn more about what we're doing. And really, at the end of the day, we're another sort of alternative in the marketplace for homeowners to be able to access the equity that they have in their home, sort of versus the more traditional products.
So, for people hearing about Home Equity Partners for the first time, how would you explain what you do in just layman's simple terms?
It's a product that's worked exceptionally well in the United States, and that's really where that's kind of what the inspiration partly was to see how well it worked in the U.S. And then partly the inspiration was to address a concern that our family personally experienced a number of years ago, where my father, as a matter of fact, had a home. It was our family home probably for about 35 years. And he had built up a lot of equity in his house. A substantial portion of his net worth was tied up in the home. And so when he went to the Bank of Nova Scotia to try and access some of that, where he had been a client for many years, the bank said no. And, as his only child, I was the one that was charged with the responsibility of trying to figure out a solution to access some of that money. And so when I looked at the more sort of traditional lending products out there, I said to myself, it seems like this industry is really ripe for innovation. And so what we've done is, like I said, we've kind of replicated on some level what they've been doing in the States for the better part of 20 years and really trying to create a gap in the marketplace. And what I mean by that is, instead of a loan that, people would typically think of when they're trying to access equity in their house and take out a HELOC or a second mortgage or refinance their mortgage to take on more debt, instead what we do is we actually make investments in people's homes. So we're not a lender, we're an investor. And so what does that mean? That means that if the homeowner wins, we win. Meaning that if the house goes up in value, then we share in some of that with the homeowner. If the house goes down in value during the term of relationship, we actually share in the downside with you as well. So unlike a lender, which is pretty agnostic or indifferent to whether your house goes up or down, we're sort of in the trenches with you, and we're taking the risk alongside you. So it's a different way of thinking about how to access equity. So instead of a loan, which has really been sort of the more popular term for as long as we can remember, now I think people should start thinking about other ways, including like a home equity sharing investment, where we invest money and, like I say, we crystallize the value on day one and we kind of see how things go from there.
So, what problem in the, because you said you kind of took away from like how the US is working in the housing market and you're applying it here, right? What problem in the Canadian housing market were you really trying to solve when you came up with or launched this? Sorry.
Like I said, I think part of it was inspired by my dad. And I said to myself, if my dad's being shut out, which I think at the time he was a pretty good credit risk, he had a high credit score, lots of equity in his house, very low mortgage, very low sort of, credit card debt or whatever. And I said to myself, if he's being shut out from a bank that they've known him for 40 years, he's known them for 40 years, then clearly other Canadians are going through the same thing. And so I said to myself, with the sort of conservative financial system that we have here in this country with the major banks and the very sort of prohibitive lending in kind of parameters, like it's not easy for people to access credit today from a TD, CIBC, RBC. I think they cater to a very special group.
Yeah.
And even if you can qualify for credit, there's obviously like a monthly associated carrying cost. And so cash flow is difficult for a lot of people. A lot of people, especially as they get older, are on fixed incomes. And so to be able to service debt, if you can qualify for $100 or $150 or $200,000, to have an associated, $1,000 or $1,500 a month payment on top of that, it becomes really stressful. So one of the key components to our product is that there are no interest payments. There are no monthly payments, and you can have the money for up to 10 years. No handcuffs. You can break the term whenever you want. There's no prepayment penalty, but you have the money for up to 10 years with not one single payment that is required. So we think there's a lot of people that are well suited to take on a product like that.
So, talking on that point of no monthly payments, what does it really mean in real life terms for a homeowner? So they're not paying for 10 years, but then how does that work?
Yeah, so at the end of the day, it really comes down to a profit split. I shouldn't even say that. It's because there's no guarantees that there's profit. A split. And so generally the formula works like this. We invest anywhere between 5 to 17.5% of the value of one's home. So those are sort of our goalposts. So if your house is worth $1 million, as an example, we'll cut you a check from the home equity partners to you, the homeowner, for anywhere between $50,000 all the way up to $175,000. So 5% all the way up to 17.5%. Okay? So that's number one. So let's say you said to us at the home equity partners, you want to access 10% of the value of your home or $100,000, right? Based on the $1 million appraisal. What we do is we say, okay, let's say you qualify for the $100,000. That's fine. Because you chose to access 10% of the value of your home, what we do then is we apply a 4 multiplier to that percentage amount. So if it's 10%, we would retain 40% of any sort of change in value in the future. You as the homeowner would retain 60%. If you'd said to me, Shale, I want to access 5% of the value of my home or $50,000, we would retain 20%. So 5 times 4, you would retain 80. If you wanted 8% of the value of your home, we would take 8 times 4. We would retain 32%. You would retain 68%. So it's simply applying a 4 multiplier to any of those numbers between 5 to 17.5%. And that really becomes the split moving forward in the event that your house goes up in value. And then it also plays in if your house goes down in value because we share in the downside as well.
What determines how much somebody can access with you guys through this program?
Generally, well, one, so the 5 to 17.5% is critical because that's going to determine the value. 2 will extend anywhere up to $500,000 depending on the value of the home, as little as $50,000. So those are in dollar and cents, 50,000 to 500,000, or 5 to 17.5%. And we will not exceed 75% loan to value. So when you bake in, if the homeowner has an existing first mortgage, by the time you factor in our product along with the first mortgage, the LTV cannot exceed 75%. Okay. And then we're in the GTA, so it has to be a GTA home. It has to be your primary residence, and it has to be owner occupied.
So your program is only available to the GTA.
Right now, predominantly, we've made a couple exceptions, and truthfully, like we would probably make a couple more exceptions. Mm-hmm. But for right now, I would say we're predominantly focused on the GTA, but it has to be owner occupied, so no investment properties.
So it's very similar to the Arbour program, but that is allowing homeowners purchase a property as long as they have, I believe, a certain amount of funds of their own to make that purchase. Then Arbour would, I guess, top up. But for your program, it's not just purchases; it's also for refinances as well, right?
We're not in the business of helping home buyers. We're in the business of helping existing homeowners. So Arbour, to your point, you're exactly right. Arbour is in the business of helping people come up with a down payment on a home. Yeah. And I think to your point, I think you have to come with a minimum, like most banks require a 20% down payment. I think at a minimum, they require these prospective home buyers to come with 5% of that 20%. So, yeah. So they'll put up in upwards of 75% of your down payment, and then they'll share in 75% of the upside in your house moving forward.
Yeah, because I think Arbour gets you to the 20% if you don't have the additional.
That's right. So they're the bridge between what you have and getting you to the 20% requirement.
And then they do the same share equity.
Yeah, they have their own kind of split, which is different than ours. Whereas we don't help home buyers, we help existing homeowners. And truthfully, we're an alternative to like a reverse mortgage. We're an alternative to a HELOC. We're an alternative to a refi, so topping up your mortgage. And in some cases, we're an alternative to selling your home, where you have to sell your house because you have a $200,000 problem, but you're selling a $2 million asset to deal with a $200,000 problem. Yeah. And that's problematic. So we can be that life jacket.
So what are your ideal clients, right? Like we talked about, you only help homeowners. What would be an ideal client for you? Because if somebody would only explore this shared equity option, if you want to call it, if they've tried all the traditional ways, right? They went to the bank, they went to a broker for a private or a HELOC, and that didn't work. Maybe we would consider you. But like, what are your traditional or your most favorable clients?
I would say that we aren't an option of last resort. I think if anything, we're actually going to start to rank higher than some of the other products that you mentioned. I think the no interest payment, like I think the reverse mortgage as an example has skyrocketed in
Yes.
popularity over the last number of
Yeah.
years. There's a massive senior demographic. And the reason why these seniors are accessing, the reverse mortgages is because there are no quote unquote interest payments. There are, except it's accruing during the term of the mortgage, meaning that, the interest meter is really running 24/7 on a reverse mortgage. You're
Mhm.
just not seeing it because you're not actually going into your pocket every
I'm
month and
paying it.
making
Yeah.
payments. So I would argue that even though seniors could probably access traditional financing, they're going with reverse mortgages because they're on a fixed income and they don't want to pay interest payments out of their pocket every month. And so when you say, people are going to come to us sort of an option of last resort, I mean, seconds and, other kind of loan programs, depending on the term and depending on the coupon rate and depending on the fees,
Mhm.
I think our program can actually be just as cheap, if not far cheaper
Yeah, and
than some of the
it's just
existing
a matter
products
of
on the
that a lot
market.
of brokers even don't even know about
Right.
this
So I
product,
think
right?
I
Yeah.
think and part of being here today is really to try and
Educate.
grow
Yeah.
awareness. But at the end of the day, this industry as a whole, in our view, is very ripe for innovation. If you look in the US and you look to other parts of the world, we are so far behind the times.
Yeah.
Like there is so much more innovative thinking around the world for how homeowners can gain access to their
Mhm.
equity. And I think we can do a lot better than simply offering second mortgages and
Yeah.
topping up your mortgage and giving you a HELOC. There's so many different creative ways that we can make it more accessible, and two, more interesting for homeowners to be able to access their home equity. So that's not like, I just wanted to sort of address
Of
that and
course.
just
Yeah.
just make sure that people understand that I think we will be a real player, not only in this space, but when people are considering different options to take money out from their home, I think people will take a much closer look at us versus some of the other products,
Yeah.
depending, particularly if they're on a fixed income and they need cash flow.
100%. I think
Um,
where homeowners get a little skeptical is like when we introduce the idea of shared equity, because nobody wants to share their equity, or, it kind of spooks them because, like, oh, they're going to take money from my property, or they're going to take this equity and I'm left with nothing. I think it's more, like you said, it's more about the educational piece, right?
Yeah, and that's been a huge focus for us. And like unlike a reverse mortgage, like I said, that kind of erodes equity for people, what they know is that at a basic minimum, whatever equity they have in their house, once they enter into a relationship with us, is all theirs. We don't touch any of it. Market conditions might
Yeah,
play into that, and there might be a further housing correction. The bottom may or may not be in. I don't know. We can't control
of
that.
course.
But we only participate in the future change in value. And so that's fine. It's not money that they have on the first day. It's money that grows maybe over time. And number two is that they can exit at any time. There are no sort of prepayment penalties. There's no handcuffs. There's no restrictions. You want to settle up with us because you're concerned that your house is going to skyrocket in value tomorrow?
Mhm.
Call us up and take us out with a traditional loan. If that's the world that you feel more comfortable in with is an interest rate
Yeah.
and sort of fixed payments every month, just call us up and you'll take out a new facility and take us out.
How did you learn more about the US housing market?
I didn't really learn so much about the housing market. I learned more about this program. And again, I think it was more because of what happened with my dad, recognizing that there's got to be a better way for homeowners to access the equity in their house. And I just went down this rabbit hole of all these different sort of products and available options in the US. And I said, like, these people are just like light years ahead of where we
Yeah,
are. We are 10 years behind where they are.
that's crazy.
And, this product has gained massive popularity, and the lending restrictions there are generally much more relaxed than they are here because in the US you have, tons of banks. You have JP Morgan, you have Goldman Sachs, you have Bank of America, you have Wells Fargo. You have all these banks, then you have regional banks and state banks and town banks. We don't have the same financial system here. We have the big five or the
Five,
big
yeah,
six.
six.
And then if you've been banking with these banks your whole life, then all of a sudden you're introduced into this whole new world and none of these names are familiar to you. And I'm not suggesting for a moment that our product is going to overshadow all of those other alternatives because there are lots of options for those alternatives and people will continue to use them. But I think we should be given a real chance
100%.
and really start to get into the conversation when people are thinking about how to access their home equity.
I agree. And thank you for educating our clients on that as
Yeah,
well,
for
right?
sure.
How do you see the space evolving in the next 5 to 10 years?
I think we're going to work like heck to make sure that we are in the mix as far as it like as far as a discussion goes, when a homeowner looks at, okay, I have $1 million of equity, I need a couple $100,000 to be able to help my kid or my grandkid or pay off some debt or buy an investment property, or I want to buy a place down south, but I don't have the equity to be able to do that. I think we hopefully over the next 5 years, like the reverse mortgage, it took time
Yeah.
to become part of like the nomenclature. I think our product will eventually get there. That's our goal, is just to be sort of a consideration and have sort of widespread attention, meaning that, okay, these guys are for real. They run a good company. They're not predatorial. They're not looking to take anybody's home. They're not looking to steal anybody's value.
I think that's
They're
what
really,
people kind of, get skeptical and take a step back and they're unsure, right?
yeah. So
But
for
yeah.
me, like, again, the inspiration behind this was a gentleman who was very vulnerable, being my dad. And I would just morally, ethically, principally, I would never open up an operation that would take advantage of people. Like, we are fully transparent. We have what's called like a homeowner success guide that's 26 pages of all the information. We insist that every homeowner get independent legal advice. They review the contract with their lawyer. We're going to be fully transparent with them along their journey. We're going to give them updates and communications and
Yeah.
so on. And really, we just want to make them feel like a partner, because we're partners. We're not in conflict with each other. We're all sort of looking for the same result, which is hopefully they can make some money. Hopefully we can make some money, and hopefully we can make it like a really pleasant experience for them while they're with us.
That's nice to hear, because I think trust is where you start first, and then the ethics behind it and whatnot.
That's right.
What type of homeowners should not consider this product?
Is it a little bit more undefined as a product versus a traditional loan? Yeah. I mean, theoretically, if you don't like risk in any sense, and you simply just want to know that every single month I'm going to pay $500, even though there is risk in traditional loans, because as you know, like interest rates fluctuate and sometimes they're up, sometimes they're down. So you're always going to be exposed to what prime is plus whatever.
Yeah.
So there's even risk embedded into a traditional loan. But having said that, if if you're more comfortable with a coupon and just kind of knowing that that's approximately what your monthly payments are going to be, it's probably a better fit for you. There's a little bit more uncertainty with our product because obviously it depends on the change in value in your home. But we're certainly going to do our best every single year to let you know approximately what your house is worth, so there's no surprises. And at the end of the 10 years, when our term expires, if you stayed with us for the full 10 years, we're going to start corresponding with you well in advance of the 10 years to help facilitate a transition. So at the 24-month mark, at the 18-month mark, at the 12-month mark, and the 6-month mark, so there's no surprises, and you're fully prepared to kind of go on an off ramp and go in a different direction. One of the things that we bake into our contracts is we might even extend. It depends, like it's on a case by case basis. But if it still makes sense and your circumstances are still like sort of attractive, we could still extend your product for another 10 years. We'll make sure that we work really closely with the homeowner to make sure that they're successful.
So there's that joint partnership. So they're not just kind
100%.
of, in the dark.
They're not alone.
Yeah, exactly.
Unlike a bank, I think in a lot of cases, and I'm not trying to poop on
Of
banks
course.
because they provide many benefits for our economy. But, at banks, it's like file number 246384. Like with us, you're a name, you're a partner, and there's lots of interesting things that we're going to be announcing over the next probably 6 to 12 months, even sooner than that, about different advantages that you're going to have simply by being part of our ecosystem.
What's next for the home equity partners? What are you expanding on or innovating?
I think really what we're trying to do is obviously we're trying to scale, and we're trying to become more sort of well-known and educate, but that's more of sort of like off to the side. That's obviously like our core focus right now. But I think what's really exciting is we're actually having some discussions with some national brands who have started to pay attention to us and potentially might partner with us.
Oh, wow.
And by doing that, that's, as an example, there's one very sort of well-known Canadian brand that we're sort of in final discussions with. And as an example, if we can forge the strategic relationship, which I think we can, that's going to be a significant perk that we can offer to any homeowner that's part of our ecosystem. So as an example, what we're going to do is we're going to hand all of our homeowners like these membership ID cards, laminated membership ID cards, and you have your own sort of unique ID. And by that, over time, we're going to have 10 to 12 partners, and you're going to be able to use your membership ID to take advantage of different discounts that you otherwise would not be able to do if you just walked in off the street.
Well, that's really
So we're
exciting.
hoping over the next, like, even maybe sooner, like 30, 60 days, we'll be able to announce
Oh, wow.
our first partnership with a very well-known brand. And I think it could be really exciting for the existing homeowners that we have and the future homeowners that we
That's
will
very
have.
soon.
Yeah.
I didn't
Yeah.
think it was that soon, but
Yeah.
that's amazing.
Yeah.
So happy to hear how you guys started and how you guys are growing, and excited for what's ahead of you guys. Thank you, Shale, for joining us
My
today.
pleasure.
And hopefully we can continue this partnership and grow.
Yeah, absolutely. Thank you so
all
much for your time.
tuning in.
Thank you.
See you on the next episode. Thank you.